Hello and welcome to Wrestling with Real Estate, where we look to choke slam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we have Charles with us. Hey Charles, how's it going?
Great, Barry. How you doing tonight?
I'm doing fantastic. Me and Charles were just talking it up before we got on the call. Charles is a wrestling fan as well, so we were just talking about a lot of wrestling stuff. So that was long. Maybe we should have recorded that as well and had a special edition, a wrestling with wrestling edition.
That could be the VIP.
So Charles, do you want to tell us a little bit about your background and what you're currently focusing on?
Yes, absolutely. So I'm born and raised in Brooklyn, New York, and I relocated to Charlotte, North Carolina last year. I was fortunate to kind of stumble onto real estate. So it wasn't something that it was a lifelong dream, but it was something that I stumbled onto, and then it seemed to fill a need in my life. And then from there, I took it further. So I was fortunate that 15 years ago, I was, for lack of a better term, young and broke. And because of that, I didn't really have a ton of career opportunities. I was able to get a position working for a commercial real estate investor who was a friend of the family. And when I first started there, I really didn't know much about anything. The guy that I worked for owned other businesses as well. He had a plumbing company and also some bars and restaurants. And my role there was basically helping him manage all of his different businesses and properties. So on the real estate side, that included everything from acquisitions to getting financing to managing properties. Most of them had more of a traditional commercial background in terms of like retail, restaurant, warehousing, industrial, but there was some multifamily in there too. So of the different industries I was exposed to, the one that I knew I gravitated mostly to was real estate. And because of that, I knew that was the one that I wanted to focus on. So eventually my intent was just to be there for a couple of years, but I guess sometimes you get comfortable in life. And that was what happened. I said, I wasn't rich, but I wasn't poor, and I was comfortable making a decent living. And, maybe I kind of forgot my dreams and said, you know what, when I first started here, it was supposed to be a short-term thing where I eventually left and went out and did my own thing. And after almost a decade there, I started dabbling into real estate. And initially I thought, well, you know what, I love commercial real estate, but I don't have the money to go out there and do it myself. So I said, let me start with single family, with wholesaling. That was my thought process. And I went out, I went to a lot of events, I bought a couple of courses, I hired a mentor, and I started doing some work in the field. But what I realized is I really didn't like residential real estate as much, and I didn't like wholesaling as much. And they're great industries and great niches, and they require a lot of skill to do. But I knew that I already had a skill set that was geared toward commercial real estate. And the skill set that you need to be successful in residential and commercial sometimes are different, because you're going to have different tasks that you do in both. So for me, I said, okay, I kind of took a step back. I was still working my full-time job. And then in 2016, for the first time, I was exposed to syndication. And I learned about that, and I said, you know what, this is great, because this is something that I can use my skill set while going out and getting money from other people, so I can get right into commercial deals, as opposed to starting with single family and smaller multifamily for years and years, and then eventually hoping to graduate into larger stuff. So I still say to this day, syndication is probably the best legal way to use other people's money. And I say over and over again, it's a great resource to do that. Now, obviously, because you are using other people's money, you have to make sure that you have the knowledge and the skill set to be able to protect it. You have a fiduciary responsibility, and don't take that lightly, because people are giving you their money and their trust, so you want to protect it more than as if it were your very own. And for me, I wound up taking some courses with the National Guru in 2017 and 18. Most of them really reinforced what I already knew about real estate, because being that I worked for a commercial investor, I had a lot of that background. The one side that was new to me was capital raising, because the guy that I worked for had his own capital, whereas I didn't, so I needed to learn about capital raising. And when you're doing it for syndication deals, there's a lot of rules and regulations that apply. There's a lot of things that you can't do. So it's important to learn those things so you stay in compliance with the rules, and that you raise money the right way and wind up running a very successful business. So then from that point, it took me about 2 years from when I first started working on it on a part-time basis in mid-2017 to find my first deal. So we closed on a 92-unit deal outside of the Atlanta market last September. And now we have a second deal, a 48 unit one under contract in South Carolina, which we should be closing on in August 2020. So that kind of brings us to where we are. And at this point, I left my full-time job in May of 2019. I still work a part-time job just to bring some consistent income in, but I'm pretty focused on the multifamily stuff, working about 40 or 60 hours any given week on that.
Cool. Yeah, very cool. Very interesting stories. Thanks for sharing that. So to go back to when you started, right, you had all these other businesses, but you said that you were drawn to multifamily out of all this stuff that you had in, I think you said you had restaurants, you had all kinds of stuff. What were you drawn to multifamily in? Why were you?
What I like about real estate in general is there are challenges and there are problems in real estate, but there's less problems I find than other businesses. And multifamily in particular, what I like about is the stability. So there's a lot of benefits to commercial real estate in general, but of all the commercial real estate asset classes, multifamily gives you the best stability. So right now, the last couple of months of the pandemic, if you own commercial properties that have restaurants or retailers or office space in there, there's a good chance that you're probably taking a pretty big discount on rent, if you're getting rent.
Yeah.
So many businesses in the country have been shut down, and it's been tough for them to make their rent payments, understandably. So it's been really tough owning one of those properties at this point, I would imagine. Whereas multifamily, while there have been some tenants who haven't paid, generally, in most markets, if you've been on top of management and on top of communication with your tenants, you probably experienced fairly good collections. Back in March, when the pandemic first started, I was a little bit nervous because we have a C-class property in a working class area of the Atlanta market. And I was concerned that, oh boy, what if tenants stop paying rent in mid-March? And thankfully, I was pleasantly surprised that I didn't have to find out the answer to that question. Our management company did a great job. They communicated with the tenants on a regular basis. I was in communication with our management company on a regular basis, and pleasantly surprised to see that the numbers have been very good. And actually, over the last 3 months, for May, June, and July, each month we've surpassed our previous highs of total net income and net operating income. So they've been great collection months, and I think that to me sums up in a nutshell why I like multifamily.
Yeah, it's like you said, right? It's a lot more stable. It's not as sexy as some of the other attractive real estate, niches out there, but it's very stable because it comes down to the same adage, right? That everyone needs somewhere to live, and if you provide a great place to live and you have a property that you've bought right, that you've underwritten the right way, and you know everything makes sense in that capacity, that you're going to be okay eventually, as long as you have a management company that's, like you said, on top of the tenants and explaining to them their situation, the current situation and their options and what they can do to help pay rent. It's going to be a stable asset.
Yep, you're absolutely right. I think you touched on something really important there, Barry. You said buying right. Mm-hmm. And that is very important because that's the one mistake you can't correct. Yeah. If you made some operational mistakes, you can correct those. But the one thing you can't do is overpay for a property and then go back and change it.
Yeah, I'm sure a lot of people wish they could, right?
Yeah.
But once you put pen to paper, that you're stuck with that deal and whatever you pay for, and so you better be happy with and understand what you pay for that property and why.
You're 100% right. So where we are in the cycle now, and I look at it and I say, okay, there are different market conditions now than there were in 2006 and 7 and 8. But I look at it and say, you know what? I truly believe, as we record this here in August 2020, we're near the top of the cycle. And I think we've had a lot of government stimulus payments that have helped collection stay strong in a lot of properties. And they've allowed tenants to be able to make their rent payments and keep the cash flowing all the way through. But what will happen is, as those stimulus payments stop, I think we're going to see a lot of operators that were undercapitalized and simply weren't good operators wind up losing their properties because they'll be distressed. And there may not be as many as there were in 2008, 9, 10, 11, and all the years that ensued, but there'll still be a pretty hefty number. And because of that, I'm fairly confident that somewhere in the first or second quarter of 2021, we should expect to see a bit of a reset.
Yeah.
So right now, it's a good time to buy, but be cautious.
Yeah. When's a good time to buy? Always, right? As long as the deal makes sense, right? There's never not a good time to buy as long as the deal makes sense. And I completely agree with you. I talk about this quite frequently, that I feel like with the run-up that multifamily's had and the exposure that it's had, right? We agree it's a great investment to be in. But what it's exposed people to is the people that are syndicators perhaps to raise money for deals, and they get money when they buy, right? They need to be buying properties to get that acquisition fee, to get that asset management fee. And sometimes people who aren't as experienced, who don't understand maybe what they're doing, they just see the bright lights of the syndication and what they can achieve financially, that they just rush into buying these properties without underwriting them, with thinking that, okay, we've had 5 or 6% rent growth here in the last 3 or 4 years. Well, that's going to continue, and they underwrite it to this. And again, they think that the vacancy levels are going to stay the same, but it's hard to imagine that that's going to be the case going forward. And this, as you mentioned there, being well capitalized is something else that I don't think a lot of people have always done with their deals over the past few years necessarily. Doing it the right way, and these things could come back to haunt these people, I think. And I think it's going to be interesting in the next, like you said, in the few quarters, what happens with that, to see, who knows, right? What they could come up with more stimulus money, and they could just keep printing money and keep giving money. And if that's the case, well, you're just kicking the can further down the road. But if it comes to an end and the stimulus money and there's people aren't getting that extra unemployment check, well, the unemployment's going to be around 10%, 8, 9, 10%, which is double what it was before. In the last Great Recession, I think it was at 8%, 8.7% or something like that. So, can you imagine if we're around there? There was a lot of pain back then. So there's going to be a lot of people that lose their jobs, unfortunately. I wish it wasn't the case, but there's going to be a lot of people that struggle to pay rent. And I think you've got to understand that. You've got to, not predict it, but be prepared for it. And I think that's where a lot of pain might come in the future,
You're 100% right on that. I agree with you fully on that. So one thing I've been telling people, because I said it's been very encouraging the last 2 months how the unemployment rate's been dropping. And I said, I have to admit, it dropped a lot faster than I thought it would. Mm-hmm. But I think the other caveat and the other side to really look out to is that it is going to be higher for the foreseeable future. So even though it's dropping, it's not going to drop back to 3 or 4%. Because during the pandemic, we've had a couple of major corporations that have filed bankruptcies. We've had a lot of small businesses that have closed. I mean, I personally know a couple of restaurant owners and a couple of other business owners that have shut down because, how do you go so many months with having no income? Yeah. And, when you're running a business, you can't. You don't have that type of reserve where you can say, okay, well, let me just have no income at all for 3, 4, 5, 6 months and keep paying the rent and keep paying payroll and keep paying everything else, because eventually it runs you dry. And for a lot of small businesses, that was the case. So while a lot of them were able to weather it out and to continue operating, there's a lot that closed up shop. So, as opposed to having a 3 or 4% unemployment rate, which, that was great while it lasted, but you can never keep that for any sustainable period of time in the economy. We may be at 8 or 9% now. And that may be the realistic, future for the next couple of years, that we're going to be at a higher unemployment rate until the recession kind of rides its way out and things start rebounding. So as that happens, we'll have more people unemployed and accordingly less people that are able to pay higher rents. So we have to be realistic and really account for that in our projections.
Yeah. And, some people, might say, well, that bodes well for multifamily, but I think what happens a lot of times, people move back home, they double up with their friend or their family, they live in, that can cause some vacancy. But I also think long term, it is good for, you don't want anyone to be in any pain, but it is good for the multifamily space, because people aren't going to be able to afford to buy houses at the same rate. You know what I mean? People, they're going to be making less money. Their savings rates is going to be way down. It's going to be harder for these people to qualify to buy homes and to be able to actually afford to buy homes. So where are they going to live? They're going to live in rental properties. They're going to live in apartment complexes. And I think that's just another reason why, it makes sense to invest in multifamily long term.
I agree with you fully on that, Barry. You hit the nail on the head again, because the thing is, that's exactly what's going to happen. So they say the running joke is that the people living in the A properties downgrade to the Bs downgrade to the Cs, and the Cs downgrade to going back to their parents or some other family relative that they can stay with for a bit until things right out. So that's going to be exactly what happens, because people do need housing, and you're right. People who are getting foreclosed on, or people who simply were looking to buy a house but they can't qualify anymore. Because the last couple of months, a lot of residential lenders have raised their borrower requirements. They require higher credit scores, and maybe in some cases higher down payments. And by doing that, you essentially price a lot of people out of the marketplace to buy homes. So people who were thinking about, okay, well, let's do this, now they may be thinking, well, let me go find an apartment to stay in for the foreseeable future, because right now buying a home is not an option. And it may be 2, 3, 4 years before it becomes an option again, because you have to wait for the recession to ride out. And what most people forget is that the recession itself is probably going to be fairly short. In 2008 and 9, it wasn't really that long. It was really an 18-month span from October 2007 to March 2009. But it was the next 4 years after that when it took for things to rebound to their pre-recession levels. That's what people are forgetting. It doesn't happen overnight. Things go down a lot faster than they go up. So it's important to be aware of that. And I agree with you, because by having a reset, you're going to weed out a lot of the weaker operators. As you said, a lot of the syndicators that got in the game. And, it sounds great. I mean, listen, it's nice to make an acquisition fee. I think everybody likes that. But the key is, if you do it in a way that's not sustainable, when you have a downturn like this, eventually those people are going to get out of the game, because they're going to realize they over-leverage themselves, and they over-leverage their investors, and they're going to be in a mess. So it is bad to see those people go through pain, but for people who are doing the right thing, I think it presents a lot of opportunities and gives people like you and I the space that we need to grow.
Yeah, absolutely. I couldn't have said it better. So let's go back into that first deal you did, right? So if correct me if I'm wrong, you looked into investing, you wanted to invest in real estate, but then you realized that multifamily and syndication was an amazing model. You ended up buying a 92 unit. Was that your first ever investment?
It was.
Brilliant. I love it. That's fantastic. It's just goes to show, right? Everyone feels like the evolution of the investor is to buy a single family, maybe a duplex, maybe the quad, then buy like 20 units, and then get into the bigger stuff. But you're just living proof that it doesn't need to be the case, right? Because really, there's not a huge difference between buying 1, 2, 3 units to buying 92, right? It's still kind of the same thing. It's still real estate. You still need tenants in there. You still need to underwrite the property. You still need to understand the market, the sub-market. You need to still understand what your business plan is with the property, So it's not a huge difference. Yes, it's 92 more tenants or 91 more tenants than a single family, but it's really the same thing. And I think that's so fantastic that you were able to get that. So tell us a little bit about how you were able to do that, how, your mindset in it and being able to do that, your comfort level. I know you had prior experience, but still to do that as your first deal, it takes some doing.
So it's always different when you're doing it as your own deal versus working with somebody else. Because even though I had the experience working with somebody else, and that was great experience, you're right. The mindset is a big shift, and you have to go out there and say, okay, I have to make sure I'm ready to play in this space. I have to make sure that I have the money lined up from other people, and that we're ready to go as soon as we find something. So my partners and I, we had looked at somewhere between 150 and 200 deals before we found this.
Wow.
And ironically, this one here wasn't even one that we found ourselves. What happened is we have a couple of sponsor relationships, and one of them we had looked at several deals with that we submitted offers on, and for one reason or another, they weren't accepted. So he knew that we were actively looking. We've been in touch for about 2 years, and we've been actively looking at deals for probably the previous year before that. So he lived right in the Atlanta market, and most of his deals are in the Atlanta market. But believe it or not, for him, a 92-unit deal was small. So he was doing 200 and 300 and 400-unit deals, so he didn't really want to do a 92-unit deal. So he thought of us because he knew that we were looking. And he said, listen, I know this deal. I know the market. I've owned properties in that very sub-market. So he spoke highly of it. And he said, why don't you check it out? So we checked it out. The numbers made sense. And it worked out great because he sponsored it, he found it, and then we basically took it and just raised the capital and run it.
Very cool, very cool. So
that worked out great. Sponsor relationships are a big thing. I always tell people, build as many sponsor relationships as early on as you can.
And when you say sponsor, for people who are watching at home, what do you mean by a sponsor?
So a sponsor or a key principal is somebody who's going to sign on a loan for you. And what that means in the commercial or multifamily side is typically they're going to have a net worth that's equivalent to or greater than the amount of the loan. And and especially right now, they're going to have liquidity equivalent to at least 9 months of debt service. Plus, they have track record in that particular space. So lenders like to see somebody who's had success in that particular sector. So if you're investing in multifamily, while it does help to have experience in traditional commercial, they really want somebody with prior multifamily experience, because that gives the lender a higher sense of security that their loan is going to be repaid and they have a lower risk of default. So until you have that financial wherewithal and that track record, you're going to need a key principal or a sponsor on your team. And ideally, you want to have a couple of them, just in case one or two of them doesn't like a particular deal, maybe somebody else will. Now, what I always tell people, the real important thing with sponsors, so yes, they will sign on the loan, but if you do a good job at developing a relationship with them, you can really use them to fast track your business, because what you can do, and only do this with their permission, don't do this without, you can use their name if you build a good enough relationship to speak to brokers and to speak to investors. So that helps you, because all of a sudden, while you may not have any credibility just starting out, now you can use Joe Smith's track record, and Joe's done 10 deals and had 2,000 units. So it's a lot easier to get better deals or to find investors willing to invest with you if you have some type of track record behind it.
Yeah, very interesting. Because I was just about to ask you that. How did you guys find deals? Because that's the challenge starting out, when, someone who has no experience going to tell a broker, I'm going to buy a 92 unit, they're going to say, okay, yeah, right. And I'm going to fly to the moon, and to be fair, you understand their perspective, because I'm sure all day, every day, they're getting hit up by tire kickers, people who are wasting their time saying they want to do big deals and stuff like that. So I think that's a lesson for anyone who's serious, who wants to get into it. It's the power of the team again, right? Nobody can do this by themselves. There's not one person buying 100 units and doing all the work by themselves. You need a team around you, right? You need to have that, you have a partner, and then you have the deal sponsor. So talk us a little bit about maybe, because I think this is a great topic, how you created that relationship with the deal sponsor. Because it's one thing to say create a relationship, right? Everybody understands that. But how do you create a relationship with a sponsor? Because they're busy people, they're successful people. What can you provide to them to create that relationship?
So there's a few different things you can do. In our case, what we did, we had actually met most of the sponsors we have good relationships with. We had met at an event. It was an event that was put on by one of the guru trainings that we went to. But they have different sponsor candidates there, and they do it every year in November. So we had went there in 2017, and they had 14 candidates there that year. So of the 14, there were some that I gravitated to, some that I didn't. Same thing with my partners. And my philosophy is, if I'm going to be in business with them, I want to be able to vibe with them, because if I don't vibe with them, it's probably going to be a miserable couple of years while we own those properties together. So the ones that I didn't vibe with right away, I kind of crossed them off my list and said, what, we're probably never going to do a deal together. Then the ones that I vibed with more, I said, okay, let's make sure we follow up. And what also helped is my partners wound up actually investing. So the guy that sponsored our 92 unit deal and the one that sponsored our 48 unit deal now, my partners had actually previously passively invested in one deal with each of them. So that got their attention and kind of got on their radar. And then from there, we just kept talking with them, and that opened the lines of communication. So that's one way for people to get in if they want to attract sponsorship and they're in a position to invest in somebody's deal. They can consider that, because that's something that will bring their attention. And then other ways are just going to different events where you might see them. Another way I would recommend is on LinkedIn. A lot of sponsors have LinkedIn accounts, and that's a good spot to reach them, because a lot of them are expecting professional networking on them. So that's a great spot.
Very cool. Yeah, Some great advice for how to people get in touch. Now, how do you compensate them on the deal? Because obviously they don't do it just for the love of the deal, I don't think, right? Or because they like you so much. That would be nice if they did, but it's got to be mutually beneficial for everyone, right?
If there are sponsors out there that do that, I don't know them. So if they're listening, please feel free to.
I'll give his phone number out. Here's his phone.
The ones I know do want to be compensated, and what they do is they typically take a piece of the GP. Mm-hmm. So that means they get part of the acquisition fee, part of the asset management fee, part of the cash flow, and part of the sale proceeds and the disposition fee at the end. So the same way that we would partake in that, they do. So the fee is still the same amount regardless whether it's one person or 10 people, but it's just how you're dividing it up. Mm-hmm. So most sponsors that I know, on the low side, I've heard of them taking 10% of the GP, to on the high side, 50%. And it depends on a few things. One is going to be the size of the deal. So like the deal we're doing now, our sponsor's taking a little more, but that's because it's a 48-unit deal that just by the sheer size isn't going to throw off the same numbers that a 200-unit deal would. Yeah. So he's taking a little more because to make it worth his while, you have to entice him a little bit. Mm-hmm. If you deal with a 200-unit property, you may be able to get away with a little less because there's more cash flow, so there's more meat on the bone to be split up. And also depends on what they're doing for you. So between myself and my partners, we're in a position where we feel very confident running deals ourselves at this point. But it also depends on the sponsor. Some sponsors will simply sign on a loan and walk away. Others want to be very involved in the process. So for us, we've been so far with sponsors that want to be involved with the process. I don't have any problem with that because I look at it and say, you know what, if I was signing on a 7 or 8 figure loan for somebody, I think I'd want to be aware of what's going on as well. Yeah. And the more they do for you, the larger percentage of the GP they're going to take.
Yeah. Yeah. And as if someone has that experience, it's never a bad thing to have them around, right? If you have that, again, it's creating that initial relationship and making sure that, as you pointed out, that you vibe with them. You don't want to partner up with someone. You wouldn't marry someone that you don't love, right? You wouldn't get in a partnership with someone that you don't get along with, because that's when the issues arise, right? That's when divorces happen and you get in a lot of trouble.
And that's a very good analogy because it's said often, but there's a lot of truth to it. Business relationships are very much like marriages, that you need to see the person on a regular basis. You need to communicate with them, and if for any reason you can't do those things, then they're probably not the right person for you. Because all that's going to happen is you'll wind up shooting yourself in the foot in the long run, because eventually you'll see that divorce coming. And just like regular divorces, business divorces can get very expensive and very costly and sometimes very ugly. Yeah. So you want to try to minimize that to keep yourself firing on all cylinders and really run an effective business.
Yeah, absolutely. Absolutely. So going back to the 92 unit, what did you guys like about it? So the deal sponsor brought it to you. He also ended up signing on the loan for you guys and helped you get it, right? Was it a case of he introduced you to the broker as well and said, so actually, let's rephrase that question. How did he introduce you to the broker and said, hey, these guys are legit. I'm going to be working with them.
The broker actually brought him the deal first, and then he actually brought the deal to us. Mm-hmm. So in that case, we did get to know the broker through him because he did introduce us. Mm-hmm. But being he was going to sponsor it, he just put the offer in on his letterhead. So that way it had instant credibility and we didn't even have to worry about, having to go through that. Yeah. Now, there are other times, especially before we close the deal, where I would put an offer in on our company's letterhead. And even though we'd have the sponsor in there, and sometimes I would usually copy them on the email so that way it would look credible, sometimes the broker would say, listen, the seller wants to see it on his letterhead. Can you do that? So I would speak to whoever it is, whether it's the sponsor that sponsored the 92 unit or somebody else. I say, listen, would you mind putting it on your letterhead, because the broker wants to see it. They just see it as more credibility, and they say, okay, fine, we'll do it. So sometimes something as simple as that, even though it may seem minute, it makes the seller happy, it makes the broker happy. So if you make their job easier, they'll make getting you a deal easier.
Yeah, so true, right? So true. So the 92 unit, what did you guys like about it? Maybe talk about the numbers a little bit. What was the business plan? And yeah.
So there's a couple of things we liked about it. So one is that this was an on-market deal, and for anybody who's looking at deals actively, they know that on-market deals oftentimes are less desirable because you have more competition, which also means you're going to have higher prices. And sometimes you may have bigger players involved, so they may be willing to pay things because their models only require lower returns than ours do. So one of the things we liked about it is there were probably 10 offers received on this property, but this particular property is called a cardinal property, and that refers to the type of construction. So they were manufactured by a company called Cardinal. Essentially, they're like almost modular buildings to an extent, and they were built in the 70s, 80s, and 90s. And because of that, the way they're designed is they're all single story, and whether you're looking at one in Georgia or Florida or Ohio, they have pretty much identical construction. They have the same construction components. They're all single story. They all have a parking spot pretty much directly in front of the doors, and they all have a little patio area. So they're designed for workforce housing tenants. And what we liked about it is that with the seller, he had a requirement that whatever buyer got it had to have prior Cardinal buying experience. So out of everybody else that submitted an offer on this property, we were the lowest one. And the reason that they came to us is because we were the only ones that had prior Cardinal experience. And our sponsor on this deal had actually closed a 2-property, 454-unit Cardinal property portfolio earlier that year.
Wow.
So we were the lowest offer, not the highest, the lowest.
Yeah.
And we were at $52,500 a door. The seller came back and said, listen, would you go up to $53,000 a door? We said, okay, listen, that's not going to break the deal. Let's go for it. So we went with that. We signed the contract. So we were able to get the deal under market. Now, to put it in comparison, Cardinal properties in the Atlanta market routinely sell in the $70,000 per door range. So we got in $53,000 a door, so it was a nice discount.
Yeah.
Then the second thing we liked was the area itself. So the property we bought is in Stone Mountain, Georgia, and it's an Atlanta submarket that's about 25 to 30 minutes outside of the city. The Atlanta market as a whole has incredible strength right now. There's a lot of job creation that's been there over the last decade. There's a lot that's going to continue. And ultimately what it is just people moving into the area. So the Atlanta MSA continues to grow and grow. And now there's about 6 million people there. So we said, okay, we have one of the strongest markets in the country. We have a deal that's being acquired under market value. And we have a property that serves a niche with workforce housing. So some people look at it and they don't like workforce housing because of the tenant demographic. And the way I look at it and say, listen, like anything else, it's all how you manage your property and how selective you are. You can get the bottom end of any demographic, or you can get the high end of it. So if you do a good job screening, generally, you're going to get better tenants. And we've been fortunate that our management company's been on top of that, and they've done that. So because of that, workforce housing is a very underserved niche in the country right now. I think I read an article earlier this year that said they would need to build like 330,000 new workforce housing units every year for the next decade in order to catch up with demand. But that's not happening. Anybody who's out there building new constructions, not saying, well, let me go out and build workforce housing. They're saying, I'm going out there spending all this money. I'm going to build luxury and charge to the moon for it. So because of that, you have a continued reduction in supply for workforce housing, but you don't have a reduction in demand, because especially as the wage gap continues to grow and grow, people on the lower and middle end of the income spectrum still need housing. So you have a tenant base that's underserved at this point, and for the foreseeable future, they're going to continue to be underserved. So from an ownership standpoint, it's a great opportunity to serve that tenant base and to fill that need.
Yeah, and I'm trying to calculate in my head, but I'm going to use the calculator. So you guys paid 4.8 for it, 4.876 for the property.
Yep.
My wasn't that good. I was trying to figure it out. So yeah, so you guys put for it. So did they need any renovations? Where were rents? What was the business plan on this one?
So the good news, and there's all different business plans you can use. So a popular term that I'm sure a lot of investors are used to hearing is value add. And value add comes in different sizes and shapes. So it can be a physical value add where you're going in there and upgrading units. It can be an operational value add where you're improving on something that a previous management didn't do or didn't do well. And this particular property was really all management value add. So that's one of the things we like about it, because I always tell people, I tell brokers all the time, listen, if you have deals that are management plays, I'll take those all day long. I said, I love those deals because I said, especially right now where we are in the cycle where things are kind of ready to roll over. I'm like, you know what? I'm not as wild to go out there and say, let me put $5 or $10 or $15,000 into a unit to upgrade it, because I look at it and say, well, between the acquisition and the cost to upgrade the units, maybe that's a little too much risk right now. Now, if you're in a great market where it makes sense, okay, if you're in a prime area in Charlotte or in Atlanta or something like that, okay, those areas probably are going to be fairly recession-proof. But if you're in a sub-market, if you're in a secondary or tertiary market, I would heavily think about investing big money into value adds at this point. So the good thing with this property is that it already had a lot of money put into it by the seller. And one of the issues with Cardinal properties is that they're wood frame buildings. And also being they built in the 70s, 80s, and 90s, this one was built in 84. You could expect that sometimes things like roofs and whatnot may not be in the best condition. And common problems with Cardinals are subflooring, the wood frames rotting, and polybutylene plumbing. So with those things, those are all things that cost money to repair and bring up to current standards. So the seller had already spent that money. So that was pretty attractive to us because they already, most of the buildings had new roofs. They already replaced the plumbing in all the buildings. They already replaced the subflooring. So we looked at it and said, okay, pretty much all the deferred maintenance that we have is already taken care of. So we knew based on our market research that in comparison to other Cardinal properties in the market and just other properties in general, the property was under rented. It had great occupancy. When we took the property over, I think it was 98% occupied, which was great. The only challenge was we had to go in there and figure out now we have to increase those rents. So we closed on it September 5th, 2019. And on October 1st, the first thing we did was we instituted a market rent increase. So for anybody listening out there, a market rent increase doesn't mean that you're increasing rents on day one. Of course, you can't just take a tenant that has an existing lease, and if they're paying $700, say, okay, starting this month, you're paying $750. They have a lease agreement, and that's a contract. So the contract has an expiration date, and you have to wait until that expires. But when you're pushing market rent, what that means is for anybody that walks in and signs a new lease, or anybody that renews a lease that's expiring, that's the new rate they're going to be paying. So October 1st, right away, we pushed market rent. And then we wound up doing the same thing in late February, right before the pandemic hit. So since we've owned it, we've increased market rents twice. And at this point, we went from having a property that was under rented to being the highest rented similar asset class in the area. So for better or worse, I said, I actually spoke with our property manager and said, do you think maybe we should try pushing market rents again? And I said, maybe I was too overzealous with that. She said, listen, right now things are, we're already the highest in the area. Let's not go too far because we don't want to be out of price for that tenant base. I said, okay, that makes sense. The last thing we want to do is price people out. So.
Well, that's great. That's a great story for, to people, because we always hear about value add, right? It's probably one of the most overused term in apartment investing, right? Everything's a value add, right? These days, even if it's not, it's used on a property to sell a property or to attract investors or whatever. But value add doesn't always mean, like you said, going in there and doing 5,000 of interior renovations so that you can get $150 rent bump. It can mean, just like you said, that market rent. So whatever that unit looks like, the market value of that property, of that unit, wasn't being had at the time, right, when you guys bought it, but you guys were able to go in there, push the rents to what the market was, what they should have been going. So it's technically a loss to lease, and gain that value through doing that, And the beautiful thing about that right now, I think, is that it's a lot lower risk, right? You're not spending a lot of times fixing up that unit, then that unit sitting empty, a lot of capital outlay with that. It's more of an instant thing. Do you want to renew at this higher price? No, okay, we're going to change you over. Or if someone comes in, this is the current rent, and it's I would say a lot less of a risky model, I would say.
And that's what I like about it, because you hit the nail on the head with that. It's lower risk anyway.
Yeah.
So my thought, and we're actually doing the same thing with our second deal we have on the contract now, because again, it's another management play where we can go in there and just operational efficiency. Now, what I would say for anybody out there who's looking to use syndication, it is probably a tougher sell to investors, because it's easier for them to wrap their heads around, okay, I'm spending X amount of dollars to upgrade the unit. We're going to push rents. Why? Because of it. So investors, for whatever reason, have an easier time understanding that than they do saying, we're going to do a better job managing it than the previous manager did. And sometimes that's a bold statement, because they may be looking at it saying, well, what makes you more qualified to do what they couldn't do?
Yeah.
And that's where you have to kind of sell yourself and sell your team, because you have to give them confidence in that and let them know that you're the right team to go in there and do it. And also that you did your market research and what you're projecting is realistic. So with something like that, and even with our second deal, like we realized we're out there pitching it to investors, we're saying, listen, we're not going to go in there. We don't want to raise all that CapEx money and go in there and spend $5,000 or $10,000 a unit. Right now, I think that's very risky. So in this particular property, the one we have under contract now, the rents of the property are between $575 and $700. And there's only one that's at $700. Most of them between $575 and $650. So for similar units in similar vintage assets in the area, the same units are renting between $750 and $850. Mm-hmm. So we look at it and say, you know what, we can go in there and increase these rents that are between $575 and $650 and bring them right up to $750 very conservatively. And we don't have to do anything more than a standard turn for that. You know, we're not going in there and upgrading the unit, just turning the tenant. So the tenant has the option, okay, well, listen, do you want to stay? You want to stay? This is the new rate. We're glad to have you. You've been a good tenant. And if you don't, then listen, we understand that somebody new will come in and pay that higher rate, because you can't find something similar in that area for less than that.
Yeah. And I think you said some important stuff there. I think it's understanding your market and how crucial your market research is for that, you know, and analysis of other properties and what the comparable properties are getting in rent, because you live and die by your rents, right? If you're predicting, you know, you clearly know exactly what competing properties are. But if you think you're going to get $850 and you only get $750 and you're raising money, it's one thing to do a deal by yourself and you're going to lose out on $100 a unit. But if you're raising money and you're giving people a preferred return and you have projected returns that you've got to hit, you're going to be in a lot of trouble. And you've got to really know your market.
You're absolutely right. So one of two things will happen in that case. Either one, you'll wind up paying that preferred return out on the backside when you sell the property, which essentially means that you're taking a smaller cut and working for free. So I don't think anybody that's listening and looking to use the syndication model wants to do that. And the second option is you're not going to be able to make that return, and then your investors are going to be upset. So I think most investors have the understanding that projections are just projections. They're not gospel where you're going to be guaranteed that. I mean, if you want to guarantee, I recommend just sticking the money in a savings account. But other than that, there is always an element of risk. So, okay, maybe we're projecting a 15% return and we hit 14. Will they be disappointed? Probably. But ultimately, you still return their money and you gave them a decent return on it. But let's say you're projecting 15% and you were way off on your numbers, and now all of a sudden you hit 6%. Yeah. There's a good chance those investors are never going to invest with you again. And worse than that, they're probably going to tell all their friends, oh, no, don't invest with them. You know, we were in a deal with them and it didn't go as planned. And, you know, we got our money back, but not much more.
Yeah. I feel like you'll only mess up once with a syndication, because it's such, even though, you know, this is national, you know, word spreads pretty quickly, like, right, about if you're doing the right thing and if you're hitting your returns. So as we're talking about investors, maybe talk a little bit about how you found your investors, how you raised that money, and how much what was your raise? What was your raise for this?
Sure. So for the 92 unit deal, our raise was $2,225,000, and we had some money that we had brought from our investors and some that the sponsor had contributed through his investors also. So with that, one of the things I would say that there's different mistakes I made along the way, and one of them that my partners and I made was not raising money as actively as we should have been. And part of it may have been stupidity, part of it may have been arrogance. I had a network of people that I knew from New York who had invested in commercial real estate, and my partners came from more of a single family background, and they had a lot of people in that space who they thought would be interested in investing. But one of the things we learned as we started raising capital for our first deal, and we probably should have realized it a long time ago, was people who are actively investing in their own deals are unlikely to passively invest in yours. It happens occasionally, but you shouldn't bank on it. So in retrospect, it seemed to make a lot more sense, and we probably should have figured that out sooner. So we got it done. It took a little bit of stress, but in a good way, and a lot of learning. We probably called everybody that we ever knew in our entire networks. We went back to getting our high school yearbooks and saying, okay, somebody here had to be successful. So we said, look, let's get everybody. We pretty much ever met, and we contacted just about everybody. Lo and behold, we got the raise completed, and we got smarter through the process because we realized, you know what? One of the keys is that you need to be finding investors just as much as you're finding deals. Mm-hmm. So one thing we did is we created more distinct roles in our business after closing the first deal. So my role is I'm the acquisition guy. So I go out and I'm in charge of broker relations. I do the underwriting, and I'm also the asset manager after we close the deal. So I'm the one in contact with the property manager, making sure that we hit those numbers. My partner, Adam, he's in charge of investor relations. So his role is basically going out there finding investors. And what we realized is that the syndication, your target demographic, especially starting out, are high income earning professionals. And they're people like doctors or lawyers or software engineers, people who make good six-figure salaries. They're probably not rich, but they're not poor. And they have some money sitting in a savings account or a retirement account that's not producing the return they want it to. And they don't have the time, the expertise, or the desire to go out there and run their own deals. So they're happy to just give you their money and get a passive return on it. So that's going to be your target investor base starting out. Then eventually, as you grow, you'll be able to attract some bigger money from things like equity groups or insurance companies or institutions or family offices. But none of those parties are going to invest in you starting out because they want to be confident that their money is going to be safe, and they want to see they have a track record before they ever consider putting money with it. Yeah. So anybody starting out, focus on high income earning professionals, and there's all different ways to attract them. Social media is a great way. I use Bigger Pockets and LinkedIn. I find that those work pretty well for me. On Bigger Pockets, one of the things I do, which actually is how Barry and I connected. I think you may have seen on a forum post that I had, and then we connected through the messages from there. So what I do is I set my emails to get notifications every time there's a post in the multifamily forum. So if it's something that I know the answer to, and I have the time to give a good answer, then I go in there, and my goal is to be the first one to respond. Because usually what I find is that if the first one to respond, everybody else, if you give a good answer, everybody else piggybacks off that answer through the rest of that post. So there are two things that happen. One is I was able to help somebody who needed an answer to that question by giving them something that I already had to give. And two, what often happens is somebody will come up and then they'll direct message me and say, hi Charles, I saw you on such and such's post. I thought you gave some great insight. I'm a passive investor, and let's connect from there. So that's been a pretty effective strategy. I think that's worked well. It's connected us with at least a couple of passive investors. So then from that point, I would pass them along to my partner, Adam, and we do an introductory call and see if we can get them into our system. So like anything else, people, you need to think of this as a business, and you need to constantly be marketing. One thing that I think all of us are familiar with, even if we don't know the name, is a drip campaign. And it can be many different things, but for anybody who's ever shopped at Amazon or Target or Best Buy or just about any retailer out there, I'm sure that you probably get emails on a regular basis, whether you want them or not, from those companies. Every time they run a sale, every time they have something going on, whether you want to know or not, you usually do. So same thing with this. We try not to inundate our people where they get that many emails, but we send out a newsletter once a month. So that way, at least they remember us to say, oh yeah, we know who these guys are, start to get familiar with their names and their faces and say, okay, that way when they have a need or desire to invest in real estate passively, they'll think of us and say, okay, let's call those guys and let's see if maybe we want to invest together.
Yeah. Very cool. Very cool. That's some great advice for, anyone who's looking to raise money for the deal and, looking towards going the syndication route. I think something that would be interesting for a lot of us to hear is, how did that initial conversation go with people when you're looking to raise money for that first deal, right? So you guys are reaching out to everyone in your network. to try and, see if they're interested in investing in a deal. How does that initial conversation, how do you reach out, and how does that initial conversation go?
Well, for the people that we hadn't spoke to in 20 years, it was definitely awkward. It was definitely awkward. So this business is very much a relationship building business. And being that we went pretty far back to really hit just about every contact we ever met, it's out of the blue when you call somebody after 20 years and tell them, listen, we're investing in real estate, would you be interested? But eventually you get over that discomfort and you figure out a way to make it work so that way you can get the deal done. And people that we had more regular relationships with, it was fairly easy. The key with asking investors for money is you never want to ask them for money. Mm-hmm. So the real key is you want to build relationships. Like anything else, you want to build friendships, you want to build business relationships. And eventually, you want to be able to put a deal in front of them and have them invest with you. So we were definitely asking for it the first time. There was no question on that because we just weren't as prepared as we should have been. And we obviously assumed wrongly that our network would have no problem funding it, which we did get it funded, but it took a lot more work and a lot more calls and a lot more reaching out to people than we initially thought. One thing I would tell people is I was glad that happened after I had left my full-time job, because from mid-2017 up until the end of May 19, I was probably putting in anywhere from 10 to 15 hours a week in my multifamily syndication business. It was consistent, but it was 10 to 15 hours a week. And I looked at it and said, man, if I had to try and raise capital while I was still working full-time, that would have been brutal. Because there's a lot of follow-up involved. There's a lot of work. One thing that people should expect to experience is it's not going to be as big of a priority for your investors as it is for you. So we all have life. We all have different things that are going on in our lives. So just because you send them a deal and say, oh, John, would you mind looking at this? John will say yes. It doesn't mean he's going to look at it right now. Yeah. And a week might go by. And John has a family, and John has a life, and John has different obligations. And John didn't look at it. You call John up and say, John, did you look at it? Oh, no, I forgot. And it never makes it to the top of their priority list. So the key with it is you have to follow up. And you have to be diligent. It's always going to be a bigger priority for you than it is for them. And you have to help escalate up their priority list that they eventually look at it and then feel confident in it. And one of the things I found great success with is when we're raising capital is we do webinars. So I find that doing a live webinar usually once or twice a week goes a long way, because even if John never has a chance to look at it, then all of a sudden he can tune in at a scheduled date and time and watch the webinar and probably get most of his questions answered. And then usually we'll do a live question and answer session at the end. So that way, if anybody has questions that weren't answered, they can get them addressed. And that gives people a sense of confidence, and it also gives them a sense of commitment because there's a set time and place for them to go learn about it.
Yeah, very cool, very cool. Yeah, and what do you guys talk about in the webinar? Is it current properties or that you guys are making offers on, the current property that you're running, what you guys is planning? How, if you do it every week?
No, so the webinars we do are only when we're raising capital. So there'll be for people that we have pre-existing relationships with. And what will happen is they usually geared around that specific deal. So like the 92-unit one, when we were doing the live webinars, it would be about that specific deal and about the team. So one thing that's very important, and especially for anybody starting out, is the deal itself is great, but for anybody who's passively invested in deals before, what they're more concerned with is the strength and the track record of the team. Mm-hmm. Because you can have a good deal that a bad team can take and turn bad, and you can have a bad deal that a good operator can take and make money with. Mm-hmm. So the team is ultimately going to be responsible for the success or the failure of the deal, and also the success or failure of whether or not your money is going to be returned. So really vet the team, feel confident in them, make sure that they do have some track record and some history, so that way when you go in there, you want to feel confident. So one of the things that we did is our sponsor on that deal, we focused heavily on his track records. We wanted people to feel confident in it. And we did give little blurbs about myself and my partners as well, because we do have backgrounds, but his background in owning real estate on the commercial side is a lot more extensive. So it gave people confidence that they could see, okay, he's involved in 13 deals. He's already sold 8 of them and made a profit that he's returned successfully to his investors. So those are all things that you want to play up during your webinars and during your marketing materials as you're raising funds, because it gives people a sense of security.
Yeah. Very good, very good. I think webinars are a great way of getting in front of investors and just showing what you're doing and showing your expertise and kind of putting a spotlight on what you're doing, right? Because people don't know unless they maybe see that. And like the newsletter is another great example of that, because if you stay in front of them, they're like, oh, okay, Charles is doing all these deals. Maybe I should, consider investing with him. But if you're not, how do they know, right? If you're not staying in front of them, they have no idea what you're doing.
Yep. And the key is, even if you don't have any deals yet, you still want to stay in front of them. You want to let them know, okay, we're looking at deals. We submitted a deal on XYZ on Main Street. Unfortunately, our offer was not selected. We're looking for similar deals, and we'll keep you informed. Just something to let people know that you're out there and you're active and you exist.
Yeah. And then, so how do you structure that first deal with your investors?
So that one there, we did a 60-40 split, 60% for the investors, 40% for the GP, and we offered a 7% preferred return with the annualized rate of return projected to be somewhere between 16 and 18%. So one of the major pushbacks that we got from prospective investors on that was the 60-40 split, which on this deal that we're doing now, we did a 70-30 because we realized that seems to be what more groups are doing. So what I would tell people, especially if you're just starting out and you haven't done a deal, you should find other groups that are doing deals, and you should watch some of their investor presentations and see what they're doing. It's always good in any business to keep an eye on the competition and see what they're doing. So 70-30 seems to be a pretty common split right now. And I think for the foreseeable future, we'll go with that. While I personally like 60-40 better, you get a lot of pushback, and it's probably not something I'll try again in the immediate future. Yeah.
That's what I'm seeing as well, a 70-30 split and a 7, or even I'm seeing as low as 6% preferred return now. Obviously, as the market keeps getting hotter, across the nation, multifamily is a space that people are investing more and more of. It's diluting the returns because obviously it's pushing, it's compressing the cap rates and pushing pricing up. So it's harder to find those 8% pref returns now these days.
Yes. It's funny because there are groups I see out there still offering them, but you're right, not as many. 6 to 8 is fairly common. I kind of feel like most are still at 7, but you're right, some are at 6. To me, when I see groups giving 8 prefs, so I look at it one of two ways. If they're established, okay, they obviously know what they're doing and they have some method to their madness that's working for them. If they're not, I always question the projections and whether or not they'll actually be able to hit that. And I look at it and say, sometimes even when I see deals that show like 20% or 20% plus returns overall, I said, you know what? I'm fairly confident that we will hit that on the 92-unit deal. But I would never want to show that on a projection. I'm always of the philosophy that I'd rather under-promise and over-deliver than the other way around. Yeah. I'd rather project 16% and give you 25 than project 25 and give you 16.
Yeah. And even 16% is a good return, right? Where else are you going to kind of get that return with, we have a tangible asset that you can go touch, look at, and that you also have amazing tax benefits that go along with it as well.
Yep, you're absolutely right on that. So that's something people overlook, and I think more people are starting to get smarter to that, because one of the major benefits to real estate over stocks and equities, and I like stocks and equities too. I know some people want the other, but I like both. One of the major benefits is the tax advantages. So you get a lot more tax benefits from real estate than you ever will from stocks and equities.
Yeah, absolutely. And it can even offset to some point, if you're investing in a large apartment complex, it can even offset some of your W-2 income, right? If because with bonus depreciation and cost segregation, the tax write-off are enormous. They can really, really add up and can make a big difference.
Yeah, they definitely can. They can definitely offset some of that income. So one of the benefits to real estate, and actually one of our investors that invested in that 92-unit deal He was a young guy, only 24 years old, but he was making a good living, very aggressive, high salary for his age. And he said, man, I'm just so frustrated. I pay so much in taxes. He said, my accountant told me to go out and find some real estate to invest in so I could start offsetting some of that.
Yeah.
And that was the reason he invested with us. And he said, I mean, obviously he wants a return, but it was really just to lower his tax burden because he said he was getting killed on taxes.
Yeah, exactly. And like you said, it's not talked about often enough. I think it's just like something that's just there, but it really can really turbocharge your path to wealth, I think.
Yep. And most people don't look at that because, okay, let's say if you're projecting a 16 to 18% return, that's not factoring in the tax benefits.
Yep.
So a lot of times your return's really higher when you factor in things like phantom income, which are depreciation and also tax benefits. So sometimes you can get far north of 16 or 18 or 25% because when you factor that in, it's a much greater return.
Yeah, exactly. Well, yeah, thanks for sharing all that. That's been really interesting for people to hear about, I think. But as this show's called Wrestling with Real Estate, and now I know that you're, as per our discussions before, you're a big wrestling fan. We're going to try and step in the wrestling ring, the Wrestling with Real Estate ring. Yeah. So the first question I have for you is, what would your wrestling name be?
There's always a little different one. So as you can imagine, through high school with the last name like Seaman, there was a lot of creativity. A couple of my friends came up with the name the Seaman Demon. I don't know if I would have wanted to go with that name necessarily, but that was definitely one option.
Seaman the Demon.
Yeah.
Cool. Okay. So Seaman the Demon is in the ring now. All wrestlers, as you know, have a special move. What would your special move in real estate be? So if you had a real estate special move, what would it be?
Real estate special move. So if it was a real estate one, on the syndication side, it's building sponsor relationships. Mm-hmm. If you want to turbocharge your business, that's it.
Great advice. That's something that I'm going to be working on after getting off this call as well. What's been the biggest body slam you've taken in your real estate career?
So the biggest one I would say, knock on wood, thankfully, I really haven't had any major setbacks. I would say it was probably my own stubbornness. And, some people, like, even though I heard these different things, some people listen right away. And then you have other people that need to put their hand on the stove and get burnt and kind of learn from that. So I'm more the latter where, okay, I had to put my hand on the burning stove and say, oh, that hurts. Let me not do that again. So I would say that for me, there were a lot of people that told us pick a target area, find sponsors, always be raising money from different investors. And I wound up listening to all those things, but I wound up listening to all of them after I made the mistake of not listening to them. And I would say for people starting out, do those things, listen to people who are more experienced, trust the process, and then eventually you'll be rewarded. Or you can do it my way and be stubborn. It'll take a little bit.
Well, that's the thing, right? You can either go there in one or two steps, or you can take 100 steps to get there, right? You can just listen to someone and piggyback off their experiences and their mistakes, or you can do them all yourself, right? So, so was there a moment that you were standing on the top rope, getting ready to jump into the wrestling ring, but you were scared? What was it, and how did you overcome it?
I wouldn't say that. A few months after getting into this, there was a deal I found that seemed to make sense. And what happened is it was in Ohio. That's where I first started looking at deals. And I had a deal that seemed to make sense financially, but I didn't have any sponsor relationships. At least none that were good enough that they would have actually signed on a loan for me yet. Mm-hmm. So at that point, it was October 2017. I submitted the offer. I was in contention for it. And I realized, boy, I don't have a sponsor. And that, for anybody listening, that is not the time to go out and start calling sponsors frantically. I've done it. So what happens is nobody's going to sponsor a 7 or 8 figure loan for you without knowing you and being confident in your ability to run the deal and protect their credit and their track record. So that deal I wound up missing on. I was on the top rope, and I guess you could say I stumbled and got crushed. And then I got smarter and said, okay, let me start building some sponsor relationships so that way I'm ready for the next deal.
Cool. That's yeah, that's definitely an interesting lesson there, because it's almost like chasing a girl, right? The more eager you are to try and get that girl, the less interested she is. And I'm sure it's the same with the deal sponsors. If you seem desperate and you know that you need them, they're going to be scared, right? I know I would be as a deal sponsor. If someone's really trying to get you to be part of the deal that quickly, it's going to push them away. So it's creating that relationship, you know, and having those sponsors that are in your network and that know you and like you and trust you, right?
Mm-hmm. That's a big thing, because they have to. You know, know, like, and trust is something very important you hit on with investors and sponsors. And with sponsors, probably even more so, because they're literally giving you their professional track record once they sign on that loan for you. So if they're not confident in your ability to protect that, they're probably not going to sign for you.
Yeah, very true, very true. Cool. Well, thank you for sharing all the information today, for, you know, a really, really fascinating interview. And, you know, it's I really enjoyed hearing how you guys dived into a 92 unit for your first deal, and, you know, did a syndication with that. That deal is obviously going to be a success, and now how you're moving on to, I believe it's a 48 unit that you guys are hoping to get into contract, right? Or you guys have it?
Yeah, so we have it in the contract. We're actually closing later this month. That one had an interesting story too, because after we closed the first deal last year, I had set a goal that I was going to be aggressive and really on top of everything with brokers. And by the end of 2019, I wanted to have the second deal identified and under contract. I was a little short of that. Mm-hmm. So by the beginning of January 2020, we had lunch with the broker that we have a good relationship with. And a few days after we had lunch, he sent us this off-market deal. So it made sense. You know, the numbers look good. And when we went out there, it was late January. And you may be saying, wow, it's late January and here we are in August. Why isn't it closed yet? Well, lo and behold, the property was in a totally different position at that point. It was mismanaged. It had 75% occupancy. Mm. And my initial concern was, of course, it's in a tertiary market. I said, maybe the area is too small. But that wasn't the problem. We went there, we toured the property, we saw the area, and we said, you know what? It's not the area, it's the management. So that gave us a lot of confidence. And then we negotiated a price. We got the deal in the contract in mid-February. And at that point, because of the occupancy, it needed bridge financing. So we had a deal lined up with the lender. We already paid them the application fee. And as everybody might know, around mid-February and early March, we had some major changes in the world, and we had a pandemic. Yeah. And at that point, I remember on St. Patrick's Day, I got a call from my mortgage broker. And he said, you know what, the lender's pulling out. It has nothing to do with you. It has nothing to do with your deal. They're shutting down their entire bridge financing program. And to an extent, here in August, a lot of the bridge market is still shut down. Mm-hmm. So at that point, we had two options. Option one was either terminate the contract before our due diligence period expired and just get out of the deal, or two, stay in it. So we really thought about it, and we went back to the seller. And what was happening in the market at that point was one of two things. Either buyers were pulling out and terminating contracts, or sellers were giving an extension of the due diligence period. So we decided we wanted to stay the course, and we said, let's go for an extension. So they gave us an extra 60 days. Then at that point, fortunately, the property actually became stabilized during the pandemic, ironically. Wow. So it qualified for agency debt. And I said, well, that was kind of the best case scenario, because with the way the bridge market was looking at the end of May, I was still leaning towards terminating it, because I said, I don't know if we'll be able to get financing for it. And being the property got stabilized, we said, okay, that worked out good. We were able to get agency debt. And that one kind of had an interesting twist to it too, because we wound up signing up with the lender, submitted the application fee. They did all the third-party reports. The deal appraised for even more than we ever expected it to. And we said, wow, that worked out good. And it seemed that all the boxes were checked financially. And we were expecting 75% LTV. Lo and behold, they finally come in with the commitment. It comes in at 65%. We said, what happened, guys? Mm-hmm. We were expecting 75. And everything checked out. You like the underwriting. The appraisal came in better than we all thought it would have. So we never really got a straight answer from them. But ultimately, we didn't wind up going with them because we said, you know what, at 65%, it's going to hurt our returns too much. So we went back, negotiated an extension with the seller again, and now we have it till August 31st, which is where we are now, and we reapplied with a different lender for agency debt. And we explained the scenario to them because we wanted to be upfront and we didn't want to waste our money or their time. And we said, listen, the previous lender, for whatever reason, they came in on a term sheet with 75 and the commitment came in at 65. Even though the deal appraised well, we gave them all the info. And they said, you know what, we feel okay being able to hit 80%. And I said, okay, you know what? If they hit 75, I'm fine with that. I'm not expecting 80. but I said, as long as it does that, our returns are close enough so it makes sense and we go forward with everything. So lo and behold, it's probably the longest process to close a 48-unit deal in history, but we'll see the finish line.
It'll all be worth it in the end, though, right? It's part of the process, right? It's part of the process. Cool. Well, before I go, do you want to share where people can find you if someone maybe is interested in
Yes.
doing a deal with you or just finding out more about what you do?
Absolutely. So I'll give you a few different methods. They can reach me on social media, BiggerPockets or LinkedIn. Just search my name, Charles Seaman, Seaman. They can reach me by email, Charles at 3, Oaks, OAKS, GMT.com. Or they can reach me by phone, 347-306-3278.
Cool. Very cool. Well, thank you for taking the time today. It's been, like I said, a lot of fun.
Barry, thank you very much for having me. It's a pleasure being on.
Cool. Well, have a great rest of your day and thank you for wrestling with real estate.
Thank you.